Today I want to talk about who exactly is going to pay for the AMC squeeze. Tons of people have been asking in the comments saying, Tom, who actually is going to pay for the squeeze if all of these hedge funds are being liquidated during the market crash? So stay tuned and let's make some money. Now this is obviously another one of my quickfire Q&A videos, and if you have any AMC squeeze related questions, be sure to leave them down in the comments below and I'll answer them in an upcoming video. And now I want to dive straight in with the key information. So, I think to explain who actually is going to pay for the squeeze, I think I really need to explain how a liquidation process actually works and where all of the money goes and how the money is lost during a liquidation. So to start from the very top, hedge funds get liquidated when their assets go to zero. But if this hedge fund is using leverage, they get liquidated when their overall fund size dips below a certain level, aka when their personal equity in that overall fund hits zero. So to give you an explanation of how exactly that works, we know that Citadel are famous for using a leverage ratio of 7-1. That means for their overall $280 billion fund, I think it may be slightly lower or slightly higher than this by now, but let's use 280 billion as it's an easy number to use. Of that $280 billion, only $40 billion of that relates to Citadel's money and its investors' money. The other $240 billion is the leverage that Citadel is using, aka loans they've taken from other major institutions, other major banks and prime brokers like Bank of America. So this fund here is in the ratio of 7-1. For every single dollar of Citadel's personal money, aka the money from Citadel and its investors, it borrows an additional $7 from external sources. Exactly the same way that you and I can use leverage on trading platforms like Webull, Robinhood and many other platforms. We can borrow money from the trading platform itself to leverage our investments. Now obviously leveraging has its upsides and its downsides. You do have to pay interest on the money that you borrow, and it does compound and exponentially increase your gains, but it does exponentially increase your losses as well. Now obviously I'm not here to talk about the advantages and disadvantages of using leverage in your trading. I'm just here to say that Citadel uses a leverage ratio of 7-1, aka $40 billion of their own money and $240 billion of borrowed money. Now again, for another example of their $280 billion fund, let's say they've used $20 billion of that for their AMC short position. The other $260 billion in their fund has just been invested long into stocks. Now these numbers are purely speculative numbers for example purposes only. We know they're shorting other stocks, not just AMC, and I don't know the exact value of their AMC short position. It may be $20 billion, it may be more, it may be less. But again, just to make the numbers really easy, let's split their fund of $280 billion into $20 billion into their AMC shorts and $260 billion into long stocks. Now for Citadel to be margin called, their fund obviously has to drop below the certain amount. Their fund has to drop down to $240 billion because at that point, their $40 billion of personal money that they have invested goes to zero. If you imagine this $280 billion fund the same as a $280,000 house, you've put $40,000 of your own money into the property and you've borrowed $240,000 from the bank to purchase that $280,000 house. Now let's say the property market crashes and your $280,000 house falls by $40,000 and it's only worth $240,000. The bank obviously doesn't suffer any of that loss. You effectively just lose your deposit that you put into the property. If the house is only worth $240,000, you've still got the $240,000 loan to pay. You effectively just lose the money that you've put in if you were to sell the house. Now, if Citadel's portfolio declines, aka their stocks lose value during the current market crash, and AMC starts to rise and their short position moves against them, two things are going to happen. Let's say AMC doubles in price and their $20 billion AMC short position becomes a $40 billion AMC short position that they still have to buy back, aka taking on a $20 billion loss. And let's say their $260 billion worth of stocks falls to only $240 billion worth during the market crash, therefore suffering an additional $20 billion loss during the market crash. Now, if Citadel take a $20 billion loss on their stocks and a $20 billion loss on their AMC short position, that in total is a $40 billion loss. That means Citadel's overall fund size has decreased from $280 billion down to $240 billion, but they've still got that $240 billion worth of loans that they borrowed from institutions like Bank of America, and therefore their personal equity of the Citadel money and their investor money goes to zero. Now, even though there's still $240 billion left in the fund, their personal money that they put into the fund, aka Citadel's money and their investors' money, has gone to zero, and therefore they experience the dreaded margin call and the dreaded liquidation. Now, at this point, the entire Citadel fund does get liquidated because they need to pay back the money that they've borrowed. Therefore, they need to sell off all their stocks, cover all the shorts, and return that $240 billion worth of loans back to the original underlying lender. Obviously, the lender isn't going to let them fly, or isn't really going to let them fly too long, because these lenders can't take on massive losses. Bank of America can't just write off a $240 billion loss onto their books for letting Citadel off the chain. Maybe these banks like Bank of America and other institutions will give Citadel some extra leeway and allow them to lose an extra $10 billion, $20 billion, or $30 billion. I don't know what the number is, but at some point they will get margin called. Now, at that point, Citadel still has these $240 billion worth of stocks that they can sell, and obviously use that money to close out of their AMC short positions, and then with any remaining money, they pay it back to the lenders, aka Bank of America. Now, obviously, closing out of their entire short position will cause AMC to squeeze, and therefore they're going to have to dig deeper into their pockets to buy back all of those AMC shares as the price starts to run during the squeeze. Even if Citadel get liquidated at the exact point when their fund touches $240 billion, at the exact point when the Citadel own equity or the Citadel personal investment into that fund hits zero, they still have to use that money to buy back all of the AMC shares, and there may not be $240 billion left when they've covered all the shorts. Obviously, when AMC squeezes, AMC will run up past $100 per share, past $200, past $500, past $1,000, so on and so forth, until Citadel have bought back every single share that they need to close out of their position. Citadel may actually have to use the entire $240 billion to close out of that position, and that's just one individual institution. You're also going to have all of the other hedge funds that are currently shorting AMC, potentially using their entire fund to close out of the AMC shorts. If Citadel do spend the entire $240 billion buying back their AMC shares, closing out of their AMC short position, it will just be tough luck for Bank of America, and they will have to recognize this giant loss. Potentially, Bank of America could share this loss with the remaining members of the DTCC, because as the DTCC goes, all of the members of the DTCC have to share the losses of any defaulting member. That's exactly what this $60 trillion insurance policy is all about. When a member of the DTCC defaults, this specific loss will be shared among all of the other members. That way, at least Bank of America doesn't have to write off the entire $240 billion worth of losses on their own individual books. They can spread it between all of the members of the DTCC. Now, if Citadel don't use the entire $240 billion to close out of their AMC short position, any remaining money goes back to those lenders and other creditors of Citadel in a certain liquidation order. When there's leftover money, the first creditor to get some of that money is any secured creditors with a fixed charge, aka any banks lending money to Citadel with a fixed charge. The second kind of company that gets money during a liquidation is the insolvency practitioners. They have their fees and expenses paid for during the liquidation. Any remaining money then goes to preferential creditors. After that, secondary preferential creditors. After that, prescribed part creditors, secured creditors with a floating charge, non-preferential creditors like Citadel's customers, and then finally the individual shareholders or the specific individual or the wider investors. After all of those AMC shares have been bought back, and after all of these creditors have been paid off, any remaining money, if there is any remaining money, goes back to Ken Griffin and his investors. And therefore we can see that when these hedge funds and institutions do go bankrupt and they do get liquidated, they're not being liquidated at a point when their entire hedge fund hits $0. They're only being liquidated when their personal investment into that fund hits zero. All of these hedge funds are using leverage. All of these hedge funds are borrowing money from other institutions and other major banks. And therefore, when their personal investment and their investors' investments hit zero, that's when these hedge funds will be margin called. We're not waiting for the entire $280 billion that Citadel holds to hit zero. We're just waiting until they lose their personal investment and they end up getting margin called. And that also goes the same for all of the other short hedge funds that are currently shorting AMC. We're not waiting for their entire overall fund to hit zero. We're just waiting for their personal investment and their investors' investments into the funds to hit zero. And when these investments do hit zero, the fund overall still has tons and tons of money and tons of stocks. It just owes that money to other institutions. Therefore, the stocks have to be sold, the shorts have to be covered, and any remaining money returned to the institutions. For example, if you're leverage trading on Robinhood, you've got $1,000, but you're using 10 times leverage. Therefore, you've got an investment into a stock of $10,000. You don't get liquidated when you lose the full $10,000. You get liquidated when you lose that first $1,000 because that's the only $1,000 that you put into the stock. You obviously still need to use that remaining $9,000 to pay back the margin or to pay back the leverage, all that money that you borrowed. And it works the exact same way for these large hedge funds. They've borrowed tons and tons of money from external lenders, and therefore, even when they're being liquidated, they're liquidated before all of the cash is drained, to the point when they still have enough money, theoretically, to pay back those lenders. But it may so happen they have to use the full money that they have borrowed from these lenders to fully close out of their AMC shorts during the AMC short squeeze. So hopefully now you can see that even though these hedge funds are being liquidated, even though they're going bankrupt during the current stock market crash, they still have money to buy back their AMC shorts because they still have to theoretically return cash to the lenders that they borrowed the money from in the first place. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.